Hello, everyone. We are Group 3, including myself, Juan Paulo, Russell, Saima, Gladys, and Isa. And today we will be presenting innovation, capital allocation, and financial sustainability of Apple Incorporation. Next slide, please. Our presentation is organized into 14 agenda. We begin with the executive summary and the key findings, and then sections 2 through 4 cover company background, financial strategy, and scenario analysis, and AI investment and sensitivity analysis. And the next sections 5 and 6 cover competitive benchmarking, strategic recommendations, and the following section 7 presents 3 real-world case studies. And then we close with implications of the study, future research, capstone discussion questions, and the key takeaway. Next slide, please. Our research produces 6 key findings that frame everything that follows. Finding 1, exceptional financial performance. Apple delivered 416.2 billion in total revenue, 112 billion in net income, and a 46.9% gross margin in financial year of 2025, confirming elite tier pricing power. Finding 2, iPhone concentration risk. A single product generates 50.4% of all revenue. A 5% demand drop removes 10.5 billion annually. The top structural risk in the model. Finding 3, AI investment justified. Adding 10 billion per year above the base R&D levels generates a 5-year MPV of 40 to 50 billion at WACC, 8.5% with a market cap increasing 4 to 6%. Finding 4, App Store regulatory exposure, a 10 to 15% services revenue haircut, modeled against EU DMA and US antitrust proceedings, creates 11 to 16 billion in annual exposure. Finding 5, R&D intensity below peers. Apple at 8% of revenue lags, Microsoft at 12%, and Alphabet at 15%. And finding 6, collaborative governance essential. Technical models alone do not produce decisions. Cross-functional alignment is what translates analysis into action. Next slide, please.
Hi, my name is Juan Paulo, and I'm doing Section 2, Company Background and Financial Position for Fiscal Year 2025. Section 2 establishes Apple financial baseline using fiscal year 2025 10K data. Apple generated 416.2 billion total revenue, a record. Net income reached 112 billion at a 26.9 net margin, confirms sustained profitability above nearly all technology peers. The operating cash flow was 111.5 billion, essentially self-financing at scale. Apple does not need external capital to fund operations or most investment. Cash and securities stand at the 132.4 billion, providing a substantial liquidity buffer. This is a financial strength that makes AI investment not just justified, but strategically available. The gross margin of 46.9 reflects Apple premium pricing power and the growing weight of high-margin services revenue in the mix. The operating income was 133.1 billion at a 32% operating margin. Total assets were 359.2 billion against a 285.5 billion in liabilities. In the fiscal year 2025, Apple also returned 89.3 billion to shareholders through buybacks with 100 billion additional authorization. This capital return is both a strength and, as we will discuss, a strategic tension when AI investors underfunded. Next slide, please. Slide 6, it's revenue and composition financial strategy. It maps Apple's revenue composition and the 3 strategic dimensions of its financial management framework. The concentration risk warning is front and center. iPhone generates 50.4% of revenue. A 5% decline in an iPhone demand removes 10.5 billion from the top line annually. This single fact explains why revenue diversification is recommendation 2. Apple financial strategy operates across 3 dimensions. First, investment strategy. All major capital deployment is evaluated against NPV and IRR and the WACC hurdle of 8.5%. R&D targets AI, Apple Silicon, augmented reality, and health geographical manufacturing. is expanding to India and Vietnam. Second, financing decision. Apple uses its debt strategy for tax efficiency while maintaining a stable dividend. The WACC formula on screen is the actual framework used in our scenario models. Third, corporate finance. Apple's stated objective is shareholder wealth maximization, disciplined by a risk-return framework that incorporates both behavioral finance consideration and ESG factor. These three dimensions are not independent. Investment choices affect the capital structure, which affects the WAC, which affects which investments clear the hurdle rate. Thank you. Yes. Russell, it's your turn.
Hello, I am MD Saidul Islam Russell. Today I will present the financial forecasting and valuation analysis for Apple from the fiscal year 2025 to 2030. This analysis uses three financial scenarios, sensitive testing, and AI investment projection of the evaluate the company future performance and value. First, the three scenario financial model present the possible outcome, adverse base, and optimist scenario. In advanced scenario, the revenue growth is expected to the remain modest at around 2% to 3% with the lower profit margin and reduce the research and development investment. In the base scenario, revenue growth is projected between the 4 to 8% with stable margins and maintaining the research and development spending. In the optimist scenario, the revenue growth could reach 9% to 12%, supposed to be with the stronger AI commercialization, increased subscriptions revenue, and continued innovations. Next, the sensitive analysis identified the key factor affecting the Apple's valuations. The most important risk is the iPhone revenue. A 5% decline in iPhone demand could reduce the annual revenue by the exponential. Another important factor is the weighted average cost of capital, or if the average cost of capital rise above 8.5%, shareholder use value may decrease significantly. Additionally, regulatory challenge related to the Apple Store could reduce the service revenue and negative effect of our valuation. Next slide, please. The AI investment impact analysis demonstrates how artificial intelligence can influence the Apple future growth. Moderate AI investment could increase the company net present value approx 22 billion. Next slide, please. Yes, the investment impact. The investments are expected to the strengthen service revenue, improve the operating margin, and the enhance long-term competitiveness. In conclusion, Apple future financial performance will depend on three major factors: sustained iPhone demand, growth in its service ecosystem, and successfully AI commercialization, while risks remain. Strategic investment in innovation and artificial intelligence provide significant opportunity for long-term value creation and shareholder returns. Thank you for your attention. Next one is Isa.
Hello. This section compares Apple with Microsoft and Alphabet and identifies 5 warning signs management should watch. First is cash position. If Apple's current ratio falls below 1.0, management should review how cash is being used. Second is profits. If Apple's profit margin falls below 20%, management should review company performance. Third is debt. If the debt to equity ratio goes above 0.70, Apple should review its financing strategy. Fourth is cash flow. If the free cash flow falls below $80 billion, Apple should reduce unnecessary spending and stock buybacks. Fifth is investment performance. If a project loses money or earn less than Apple's required return of 8.5%, it should not be approved. These five triggers become the governance thresholds discussed in the next section. Next section, please. This section presents 7 recommendations for Apple. First, increase AI investment by $10 billion per year. This is our most important recommendation because it creates the highest value. Second, reduce dependence on iPhone sales by bringing iPhone revenue below 45% within 5 years. Third, prepare a backup plan in case Apple Store revenue falls 10 to 15%. Fourth, continue expanding manufacturing in India and also consider Vietnam and Mexico. Fifth, keep the debt to equity ratio below 0.70 and maintain at least $120 billion in cash. Sixth, invest in profitable AI projects before increasing stock buybacks. And seventh is create a strategic finance committee to improve decision making and oversight. Our top 3 recommendations are AI investment, governance, and revenue diversification. Thank you very much. Next is Shaima.
Thank you, Lisa. Hi, my name is Saima Sultana. So now I'm presenting section 6, which is collaborative decision making framework. It's present the governance architecture that makes our 7 recommendation operationally executable. So this framework has 4 components. The first one, we have the strategic finance committee. The group includes senior leaders such as the CFO, COO, product heads, legal counsel, and board representative. They regularly review financial performance and discuss important strategic decisions. The second component is formal scenario review. Since business condition can change quickly, the company review different possible scenario very quarter. This helps management identify risk early and respond more effectively. Third one is cross-functional capital allocation. Every significant investment require NPV documentation and a scenario impact assessment. Designated executive owned ROI accountability by project. This eliminates the principal agent gap by making accountability explicit. The final component is regulatory contingency planning. The App Store playbook is pre-positioned with pre-authorized allocation amount and a liquidity buffer maintained above the $120 billion cash flow. Overall, this framework is designed to more at competitive speed while maintaining board level accountability. Next slide, please. Okay, this slide shows 3 real-world case studies that support our governance framework and its recommendation for Apple. Case study 1 is Microsoft Cloud transition. So Microsoft shifted capital from its mature Windows and Office business into cloud through strong case, functional investment governance, and clear NPV threshold. As a result, Azure is scaled to a $100 billion run rate. And the key lesson is that a strong financial performance should enable transformation, not delay it. Second case study is Apple App Store regulatory response. Facing regulatory pressure that could threaten 11 to 16 billion dollar in revenue. Move like Apple One, Apple Card, and App Store ad help offset risk. This lesson is regulatory risk is financial strategy issue, not just a legal one. Case study 3 is Samsung supply chain diversification. Samsung reduced dependence on China by expanding production in Vietnam, India, and Mexico. This helped it maintain supply during COVID disruption while competitor lost share. This lesson is supply chain diversification can deliver both cost efficiency and revenue protection, often exceeding the WACC 100. Overall, each case support our recommendation. This Microsoft validates R1, Apple's response support R3, and Samsung support R4. So thank you. Next presenter is Gladys.
Thank you, Saima. For the last section, the comprehensive conclusion, I'll cover 3 things. What our study means for Apple, what we recommend for financial executives, and where future research should go. For the implications of the study, there are 4 points here. So the first one is strength and vulnerability coexist. The numbers show how big AI decision is. Good strategy needs governance, and AI timing matters. For these implications led us directly to our recommendations, which I'll cover now. For recommendations for financial executives, recommend that make sure every investment earns its keeps. Well, Apple should not measure R&D success by how much money it spends. Instead, each investment should be tested. Does it return more than 8.5 cents for every dollar spent? After adjusting for risk, if not, it's destroying the value. For recommendation number 2, set a real target to reduce iPhone dependence. Recommendation 3, the App Store legal risk is a finance problem, not just a legal one. For the 4th one, watch the warning signs. Do not wait for the annual reviewer. Finally, decisions made by one person are riskier. We also have suggestions for future research. For this study, we raised 5 questions. Question 1 is, did the AI investment actually pay off? We projected 40 to 50 billion in value for AI investment. So in 3 to 5 years, real data will exist to test whether that projection was right. The study is very important for this one. Then for the second question that we raised, what will be the App Store regulations actually cost? For the Europe and the United States, they are still making decisions about Apple Store rules. Once those rulings are final, researchers can measure the real financial damage and compare it to what we modeled. Third question we raise is, does better governance actually lead to better decisions? Well, we argued that cross-functional teams make better capital decisions. For the 4th question, does investing in sustainability save money? We believe so, because companies that score well on ESG may pay less to borrow money and avoid expensive legal problems. For the final question, on-device AI vs cloud AI, which approach cost more? Apple processes AI on your phone, Google and Microsoft use the cloud. These are very different cost structure. A financial comparison would show which approach creates more long-term value. For our key takeaway and closing, I want everyone to remember that from Group 3's presentation today, Apple's financial strength, its greatest strategic asset, and the window to deploy it proactively before competitive and regulatory pressures narrow it is now. For the closing words that we have for this report, this concludes that Apple will spend less on R&D and Microsoft and Google. So these are questions that we can provide you some answers. But in the meantime, this concludes our section for Group 3's presentation. On behalf of Brian, Juan Paulo, Saidor, Shaima, Isa, and myself, thank you very much, and we welcome your questions.